Hello, everybody. Kirk Spano, Investing 2020s, and that QQQ correction that I suggested was coming back at the end of July. And what could make that happen? Well, it could be that Apple and Microsoft start to correct. So far, Apple's been taking it on the chin, and I got a feeling that Tesla still will. What drove Apple down? Well, first off, I think a lot of people are concerned with valuations in the stock market, and we will address that in just a minute. The great bifurcation, the great divergence, what I've dubbed it, is clearly happening. And it's happening at multiple levels. It's happening not only in these sectors, but at the market cap level. The zombies are slowly being killed. First, some of the regional banks, but also some of the big companies that just don't have any underlying growth. Those companies with no underlying growth that also have a lot of debt, you'll see in a note from FactSet, have really got a troubled future ahead of them, especially with Fed Chairman Powell and the rest of the rock and roll band known as the Federal Reserve talking about keeping interest rates higher for years. I think they're blowing smoke up your wazoo, but they will be higher than they were when they were zero. And a lot of companies relied on very, very low interest rates. And I will tell you right now, interest rates are not high. They're higher, but they're not high. You are seeing the great normalization, something that I've told you about for years. It's been part of my thesis with the dollar going back to 2012 at MarketWatch. I've been a dollar bull in the face of the chant. Dollar dying, the dollar's dying, the dollar's dying, it's the end of the dollar. And all those knuckleheads pounding their chests, stomping their feet, pounding on tables for 11, 12, 13 years. I've been wrong, 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 and they will continue to be wrong, wrong, wrong. Unfortunately, in their disturbance, they will never be silent. And that's too bad because they don't know what they're talking about. They've never known what they are talking about, but they scare people. They sell newsletters. They get in print. They get on TV, and they make a lot of money scaring you into thinking about stupid shit. The United States has the strongest large economy in the world. By far, not even close. So when China has a company that releases a cell phone with a little bit better chip than we thought they might have, and then weirdly, a week or two later, they tell everybody in the government to get rid of their iPhones, I think that's kind of suspicious, don't you? So this sell-off in QQQ is a gift. It's the gift that I've been looking for, and hopefully it's the gift that keeps giving, because if we can get in the QQQ cheap, it is the number one top, not even close, far and away, best core holding you can have. It's Fred Flintstone pounding the table. So Apple has significant revenue in China, and it appears as if the government's going to stop buying their telephones. Okay. It's going to cost Apple a few percent of their market cap. But in reality, as Apple becomes a more American and a more Indian company, it's not going to matter much. And frankly, I still see a deal between the United States and China at some point if Chi-Chi can come to his senses, and I think that he can. As arrogant as that man is, he's not as bad as Putin. Now, I say that only because I put Putin in the evil as hell category. Delusional and evil and dangerous. Xi, more tactical, arrogant, but when things come to a head, he will generally make better decisions than Putin because he knows that making the Chinese people angry would be the end of him. There is no way to contain the Chinese the way that Putin contains the Russians. There's just too many of them. So eventually, China is going to cut a deal on sanctions, on technology, on clean energy. All these things are coming. Now, will they happen before the election? Hard to know. I'm sure China would rather negotiate with Trump, who's like the world's worst negotiator. I mean, anybody who can bankrupt a casino is bad at what they do. Good at marketing, good at trumpeting, bad at business. bad at negotiations. So what does this mean? Well, first off, here's the company that made the 7 nanometer semiconductor. This is not quite as good as Intel and certainly not as good as Taiwan semiconductors. So that means that the deal on technology probably is sooner than later, because what they just did is they probably cut 5 years off of what they were trailing by. They were probably a decade behind. Now they're like 2 models behind. I mean, they're just, they're catching up quick. And remember, China did this weird thing over the last 20 years. They sent people to school to become engineers and scientists, really made it easy for them to become scientists and engineers. I just wonder what would happen if we ever did that in America. Maybe there's a solution on the political front for that. Probably the opposite of people who talk about getting rid of the Department of Education. So China's market outlook for the second half of 2023 is looking pretty meh, not horrible, not great. One of the things you have to keep in mind with their real estate problem is that they built all those ghost cities. If the federal government, if the government of China ends up doing a bailout and taking possession of a lot of this real estate, which is what I think is coming, they can turn around and move people into those cities, give them a place to live, and say, okay, here's the deal. You can move here and have a free or next to free, almost free place to live. Just help us fix up the city. I mean, that was one of the problems, is that they built all this expensive housing and it never really got sold to anybody. So now all those developers are having a problem, and the bailout's going to go something like this. Hey, developer, you're bankrupt. We're going to bail out the banks, and we're going to give you work to redevelop. Fix all that stuff that you already built that's fallen apart because nobody moved in and it just got dilapidated. That's what's going to happen. I talked about this years ago, 5, 6, 7 years ago. Why don't they just put people in those houses on some sort of subsidy and make sure that things don't fall apart? Say, look, if you pay this low rent, you own it after 10 years, something like that. Get people in those cities, make them vibrant, create an economy. Now, I understand that they pretend to be market-based over there, just like we do here. We pretend better, but we're bailing out regional banks right now. It's all part of growing this giant economic pie, because the economy has to grow at least as fast as population growth, or you got a problem. Plus, you want to improve standard of living generation after generation. So if population growth slows down to 1% in the United States, and I think it might be lower than that already, that means that we need 1% growth to compensate for population growth. And let's say we had another percent because of immigration, which is sensible given the aging curve. It means we need 2%, but the immigration probably brings that. Then we need another maybe 1 or 2% to pull everybody up. All these things are pretty easy to do, actually, but because it entails change entails transition, and transitions scare people, and transition scares people, you get the thumpers. It's all going to hell. It's not all going to hell, man. They've been telling us that forever. It's going to hell. And it never does. Yeah, speed bump here and there. China can fix their problems. Our problems are pretty minor. So when I told you the QQQ was going to correct, it wasn't me dooming and glooming. It was me telling you, watch out for this. And when it happens, jump on it. When I make a macro forecast, I'm not too concerned with exactly when it happens. Almost everything that I say on the macro side eventually happens, usually pretty similar to how I said it would happen. Timelines are easy to fudge for a year or two, sometimes even longer. But when something that makes sense happens, if it's been in your head as something that might happen or probably will happen, you should be prepared for it. Don't say, well, Kirk talked about this last year and it hasn't happened yet. Or Joe Schmo talked about this and it hasn't happened yet. Must be wrong. Well, people who think like that are shitty investors. They generally don't handle their own money well to begin with. So I tell certain people, don't trade. Don't manage your own money. Just hire me. Go do something you like and that you're qualified for. So I only bring this up because the transition from TD Ameritrade to Schwab happened over the weekend. I now have the ability to trade at Schwab. And I said that I would offer a discount to anybody that moved an account over by the end of the year. So anybody who wants to hire me, You get a 25 basis point discount right off the bat because I want you to do things that you're good at and that you enjoy. If you're managing your money to save 1% in expenses, but you don't enjoy it and you feel overwhelmed, you are making a mistake. All right, back to this. This is what's pulling the NASDAQ 100 down, but not exclusively. There's other stocks that are also falling. I have a chart that I'm putting into an article that will show that I think it's everything but Meta and Microsoft are down now this month and since last month. And it's 5 out of 7 are down of the Magnificent Seven. So what we want to do is figure out when this decline ends. Shooter, this is one of the chat rooms at Fundamental Trends. I've just had him putting the charts up in here, and then I parse them out into articles. So it looks like we could see QQQ down to 373, but if it goes through, then it probably heads all the way down to maybe 350 something or 340 something. But then this is pretty strong support, 340s. Oops. You can see, and this is similar to Teresa's charts, you can see where the zones are, where price starts to bounce back up. And what determines that? It's a combination of things, right? People say it's the technicals in the market mood. However, the big guys aren't just running around willy-nilly. They have a plan. Their plan is based on something other than price. Price is just a manifestation of what they're looking for. And what are they looking for? They are looking for price to earnings ratio forward that jives with their earnings estimates. So if earnings flatten out, it's that line, go through a wavy period, which is what I think is going to happen for the S&P 500, but I think NASDAQ is going to continue higher. Why? Because it's pretty cheap. It's not as cheap as it could be, right? We see the range. You've gotten a PE up into the 30s. This is why I called for a correction in 2020. It had nothing to do with COVID. I didn't know about COVID when I called for the correction. And then a month later, we saw COVID. I told everybody it's the most important story in the world and that would be a catalyst. And I twice said sell almost everything, January and February 2020. So right now, we're a little bit below the average PE for the QQQ. And this is backwards looking, trailing 12 months. The forward is about the same because they're not seeing earnings jump again, according to the analysts. So if you go here, there's another chart in here. And interestingly, they pick out the exact same stocks that I picked up to watch, Apple and Microsoft. Here is the forward PE. It's at the level that it was after we had the COVID V rally. Now, this is kind of high. If you go further back, you see that even this is just a little bit high. Somewhere between 22 and 20 is normally where a normal correction takes to QQQ. There's only been a few times that it got below that 20 level. COVID, financial crisis, I believe in 2018 it did, and obviously the dot-com wipeout. So what we're looking for is we are looking for PE, forward PE on NASDAQ to get down to around 20. And if it goes lower, I mean, that's just a gift. How do we compare this to the rest of the market? This great diversification, this great divergence I've talked about. Well, I told you that not only are the sectors changing, which has been going on a while, but now you're starting to see new leadership. And you should think of it like this. Profitable growing mid-caps are probably the sweet spot of the market. It gives you the combination of past the failure stage and starting to get close to getting S&P 500 money from the indexes to hold up their stock price. So it acts like a magnet. Your biggest gains can be made in small caps, but indexes don't help you there. You have to pick those companies out yourself, and you have to know something about them. There's just not very many good ETF strategies for small caps. I've picked out a couple. One has to do with value and momentum, and the other one has to do with earnings growth. And those are good places to start. If you get a cheap small cap that's earning money or just about to, right? Because so many people look backwards. When you buy your small cap, if you can just get a few quarters ahead of the crowd, because you're looking the next year when they're looking at last year, you're generally going to do really well. Ametis, right? We were probably 2.5 years, two and a half years ahead of profitability. And we're learning to wait until you're only about a year ahead. Spire Global, looks like we're right there. Or it looks like we pegged that one right at the bottom. I mean, it looks like we might have bottom ticked 2 stocks this year. Like bottom ticked stocks that are going to triple or better in the next couple of years. That's pretty nifty. Charts like this help you. You see that the PEs here are pretty low on the small caps and on the mid caps. And even though there's been a correction in the large caps, still not low, right? Still has a PE up around 1920 on the S&P 500. And if you remember your price to earnings to growth ratio, PEG, the one that Peter Lynch likes, made billions on, you need a growth rate that is similar to the PE ratio so that the combined ratio is between 1 and 2. What does that mean? Okay, so if your price on a stock is 20 and the earnings are 1, that means your PE is 20, correct? 20 over 1. If the growth rate is below 10%, that means that you have a PEG ratio, PE to G, of over 2. In those cases, usually stock doesn't do so well. We have decades and reams of data to show that. You have PEG ratios over 2, and generally in the 3 range or higher, or negative because you don't have earnings, right? That's a whole different equation because it's not positive. In large caps, a company that's not profitable, they had better have a heck of a turnaround plan. You got to remember, most turnarounds, what? Say it, never turn, don't turn. Thank you. Right? What movie was that from? Say it, Sam Kinison. Well, the small caps and the mid caps, they both grow more than the large caps because they're further down on their S curve, very basic economics. The small caps, the ones that survive and execute and probably have some luck, maybe have some government policy on their side or a secular trend or both. They have improving financials, maybe a good short squeeze. Sounds familiar. Have we seen that lately? Yeah, we have. We're going to see more of it. So with the small caps, you do have to pick them out. The mid caps, same thing, but you can't index the mid caps because the ETFs are generally market cap weighted, and the larger mid caps are the ones that get sucked into the S&P 500. So like I said, it's just a magnet. In order of historical performance the last 100 years, small caps have done the best, mid caps have done the next best, and large caps have done the least best. Those are facts. It's been different in the indexing era. I'll ask you a question. When people who are buying VOO and SPY see their returns chop along for 5, 6, 7 years, which is what I think is coming, and at some point there's a big correction, probably the boomer crisis that's coming, the boomer retirement crisis, it's pretty much guaranteed. Do they throw in the towel? Is that the catalyst for seeing tons of mid-cap tech companies and clean energy companies get put into the S&P 500? I think probably. When does that happen? End of the decade sometime, I think. I don't think it's 10 years away. I think it's 3, 4, 5 years away. The estimates I've seen on when that budget crisis occurs, which again is pretty easy to fix, right? We have this thing called QE now. That's why we're shrinking the Fed balance sheet. It's reloading the bazooka for next time. I've written that article. And the bazooka is almost done being reloaded. Interest rates are close to peaking. Maybe they go up a little bit more, maybe not. Quantitative tightening, $1 trillion got sucked out of the financial markets in the last year. Going to be $1 trillion more in the next year. Unless they pull back on that, maybe say right around convention time, right? Make your note there. Kirk says that quantitative tightening gets reduced right around convention time, maybe a little before. And why would that happen? And they might not even call it that. They might do quantitative tightening on one side of the balance sheet, but then the Fed will bail out a bunch of banks on the other side. Oh, well, that's just a one-time thing. It's an adjustment. See that on balance sheets all the time. Oh, yeah, our results are really much, much better. We just had this one-time thing. Well, you had a one-time thing before that, and a different one-time thing, and a different one-time thing before that. Story time, narratives. The thing that we see over and over and over again, though, if I can find the chart for you. I had it. I must have closed the window, but I had it. Oh, I know what it is. It is here in FactSet. And there it is. There you go. Sector level change in earnings. I was on the right page, the wrong page all at the same time. Look, consumer discretionary communication services. Remember, they changed that index. They pulled Meta and Google from tech and put it in communications. So even though Warner Brothers Discovery and Paramount and Comcast haven't done that well, and AT&T hasn't done that well, and Verizon hasn't done that well. You stick Google and Meta in that index, and suddenly, woohoo, earnings growth. And because of the consolidation in the streamers and cable providers and whatnot, probably get another boost soon. I'm writing an article called The Labor AI Wars Have Already Started. That'll be out next week. I'm actually going to do 3 articles pretty quickly on labor and AI. And I'm also going to write an article about labor and the Fed. Should have been out this week, but got busy. See these 3? Information, communication services, consumer discretionary, and then energy. And this is still only a small itty bitty amount of clean energy. Most of it's still oil and gas. But what happens as clean energy takes over the energy market the next decade? These are probably your 4 leading categories. Remember, the oil and gas companies get carbon capture. That's how the government bought them off. So if the S&P 500 growth is 0.4%, and it's only those 4 categories that are growing, everything else is flattish to falling, what does that tell you? Then weirdly, take a look at materials. People want to tell you to buy materials. But what do we know? We know that there's really no longer a finite amount of minerals and metals. We know that we have over 100 years worth of pretty much everything, if not 200 or 300. We have cleaner mining techniques. We don't need as much of the metals because we're figuring out how to not use the things that are scarce or rare. And by the way, we're sending a satellite to an asteroid later this year to see how we can mine it. And as soon as that happens, as soon as we can mine asteroids, that's it. There is no shortage of metals, minerals, materials ever again. So long as we don't burn ourselves to a crisp because we're idiots, we'll be pretty close to carbon neutral at some point this century. I think we probably get there. Like I said, they're going to pay Exxon to suck carbon that they put into the atmosphere back out. This tells you the future. Consumers have to have better standards of living or they get cranky. And when consumers get cranky, politicians get kicked out. And politicians hate that. Communication and IT, those 2 things are merging. So they just created 2 categories for tech, basically. And entertainment is in there with communication. And then energy. Real estate. That is the one that I think probably pops back up there to positive really soon. Hence why I have really been focusing on private real estate, mainly because most of the REITs suck, right? The executives suck so much money out of those REITs. Ask yourself why the Simon family is as rich today, actually richer today than they were 20 years ago. Take a look at what their shareholders have actually made in real returns. It's just a big wavy chart, completely dependent on interest rates. They've been terrible at managing the whole Amazon thing, but everybody talks about, oh, Simon Property, it's got a fortress balance sheet. Bullshit. They hand the keys back to malls. If they had a fortress balance sheet, they would have redeveloped them. It takes a dozen guys like me to raise a couple $100 million and rebuild their malls for them. Granted, we get ownership. So think about where we should be investing. People say, what about healthcare? Look at healthcare. It's way at the bottom. And why is that? It's because healthcare is a huge part of the economy. It's twice as big as it should be. So what is the pressure on healthcare? The pressure on healthcare is to have deflation. The government wants it. It's necessary to save the economy. So one thing that can destroy the economy. That's why we invested in a company that should help bring about healthcare deflation. Somebody posted in the chat room the other day. An article was a month after we talked about that company. An article came out and said exactly what I said. This is the way it's going to go. This is how AI is going to impact healthcare and healthcare inflation and deflation. And interestingly, in QQQ, this goes back to QQQ, AI, the impact of AI will actually be deflationary on almost everything, especially healthcare, also manufacturing. And if you're watching what's going on with the UAW and the car companies and with entertainment, what you're finding is that the number one thing is job security. They're asking for all kinds of raises and days off too, but it's really job security. And they'll get some of that other stuff. If they really, really wanted to do well, they would figure out a way to get in on profit sharing, increase the profit sharing. And you have to do that by some sort of stock ownership. Bonus systems work pretty good. However, ESOP programs are where it's at. If you work in a company or an industry and you get a piece of the long-term profits, A, you work hard, and B, you're putting a cap on what the executives can skim out for themselves. That would even be a great rule in some of these negotiations, right? The executives can't get any bigger a raise than the rank and file. And given that the executives make 100 times more than rank and file anyway, should be okay that they all get the same percentage raise in the future. Executives still get the most of their big skim. I really do think that's the name of a good book that I'll be writing. The Big Skim, chapter book, industry to industry, how they do it, how they steal your money. As an investor, though, you got to go back and say, okay, how can I do the best for me? Here it is. It's right in front of you. QQQ is mainly made up of consumer discretionary, communication services, information technology, and clean energy. QQQ does that. That's how it's designed. You own a house, you should probably own at least a second property, and I'd recommend just keep buying property until you don't have, the income to do it. Once you retire, you're pretty much done buying property. Now you're sucking out income and figuring out if you're going to pass it on or sell it. And if you are leaving an inheritance, then buying more real estate can make sense. But really, you should be buying as much real estate as you can from the time that you can start based on your income to like the year you retire. After that, you got to figure it out. QQQ, if it's not a big part of your portfolio right now, and that's fine because it's getting beat up, you need to be figuring out how to scale in between now and the end of the year. Because I think between now and the end of the year is probably the choppy period. Maybe there's a big correction, but I think it's just choppy. Maybe we end up the year at the bottom of the chop, but then they have to solve the budget crisis by the end of the year. Not even budget crisis, the budget negotiations, right? They have to figure out what gets cut and what stays the same because they're going to increase military spending. Eventually, that has to come down. Probably not much, but if in real terms it came down, right, it just didn't go up, and then inflation nicked it away 1% or 2% a year. At some point, we have to flatten military spending. Hopefully, that happens immediately after the Ukraine war because there's no new war to replace it. That would be swell. I got 4 months, don't I? I said little Vladdy would be out by the end of this year. If it happens next year, people go, well, you were wrong. Whatever. It's coming. And when it comes, the next thing we have to look at is the potential to invest in Russia. Because Russia should be a super economy, and they have successfully upfade their economy for almost a century. So anyway, when we take a look at the charts in real time, right, this is a weekly chart, we will figure out, is it this support level or does it get a little deeper, right? Does it come all the way down here into the 200s, right? This is the monthly chart. And on the monthly, if we do get a crisis, we get that Jeremy Grantham moment, you're looking at somewhere in here, middle 200s on QQQ. You can go all the way back to 2018. End of 2018, it got down here. And maybe COVID should have driven it all the way back there. But then all that money, and now they're sucking the money out. So the financial manipulations of the government and the Federal Reserve since late 2019, right? Because we did QE again here. And look at that. COVID crash, more QE. This level down here would actually be super duper healthy and a generational buying opportunity. If we only get down into here, it means that we probably have another big correction coming. And I think that would be the boomer crisis. So maybe something like this, right? Because I just don't think we're going to get here this time. We could, but I would anticipate the next time that we're down under 300 on QQQ, and I think it will happen. It's probably several years out. There's still just a lot of money out there, and the problems that we're facing at the moment aren't all that severe. People can talk about how severe they are all they want, and they just keep being wrong, right? They just keep being wrong. The QQQ opportunity is coming.